Well, for the time being, let's focus on a couple of sectors then. Let's focus on the housing finance space. Mr. Girish Kousgi, the MD and CEO at Canfin Homes, joins us to discuss how are things panning out, as well as the outlook for FY23. Hi, Girish. Always good speaking to you, sir. Tell us, how are you seeing demand shaping up? Are things, solid? Are you seeing a good amount of traction on ground? And if yes, break it up for us. Where are you seeing demand coming from? The luxury segment, the affordable housing segment? Go ahead.
Good morning, Nigel. I think demand is still intact in spite of rates inching up, in spite of cost of construction going up. That's simply because I think the demand is quite robust in spite of these two small deterrents. Still, I think demand is looking quite good. It is looking good in almost all the segments. Maybe premium and super premium segment, I think there's been slight, comparatively, slight less demand. Otherwise, I think it's broad-based and it is pretty okay across geography as well. If you look at last year, Q1 was not that good because of COVID second wave. In spite of Q1 in last year not being well, most of the companies and the industry did well last year. In fact, most of the companies clocked highest ever numbers in the remainder 3 quarters of last year. And therefore, this year, I think at an industry level, 11 to 12% growth would look decent enough. So in that sense, I think demand is quite intact. There's been slight impact in the demand, but I think that's not big enough.
Okay. So, Mr. Kousgi, I agree that demand has been very strong. In fact, your AUM growth was what? Almost 24% year on year in the quarter gone by. Can you give us some estimates for the full year? What are you looking at?
Good morning, Sonia. No, we are looking at about 18% growth in both disbursements and book. I think there might be here and there quarter slight ups and downs. I think at a consistent level on a steady state, we look at 18% growth.
Right, Girish, what about your NIMs? You had indicated that maybe there could be some bit of tapering down out there. I think with the past quarters in that 3.6, 3.7% odd, majority of your borrowing, I guess, comes from banks. In a rising interest rate scenario, what is the steady state on NIMs you'll be looking at?
In fact, I've been saying this since last 9-10 quarters. I think for a company like Canfin, which is completely into retail, no corporate funding, no developer funding, non-home portion being very, very less in the portfolio, largely focusing on affordable. I think spread of 2.4 and NIM of 3. So today we are slightly above what I mentioned now. I think as a guidance in the long term, we should look at 2.4 and 3 for Canfin, because we are 100% retail affordable small ticket company. I think that is what we're looking at. I think it's possible that for next few quarters NIM could be around 3.5, 3.6, but I'm talking about long term. We should look at upwards of 3 and not less than 3. I think that's the guidance.
In Q4 of last year, you even managed to do 4.1% NIMs. You won't get to that level anytime soon, you think? Now that everything has recovered and there's big demand?
Yeah, I'll tell you, no one expected COVID. Yeah. Right, and how COVID had an impact on the entire industry in terms of growth, in terms of margin and profitability. I think in spite of COVID, we were able to maintain because our guidance was forethought well in advance, and we had given a guidance of 2.4 and 3. And if you remember, I think spread came to as low as 2.41. So I think, which is why I always look at long term and say this is what is the long term guidance. In the short term, yeah, there could be slight ups and downs. I think market is looking good. Now, what we have done is we are pretty aggressive on growth. Because we are aggressive, our rates are very competitive. And therefore, margins from the current level would come down to a certain extent to ensure that we grow at a faster pace, because we are looking at newer segments. We are looking at slightly better profiles. We are doing very good profile, I think slightly better in terms of our ticket size, so that we can also grow the book at a faster rate. And therefore I say that margins, they could be little contraction, but definitely about 2.4 spread and 3% NIM.
Okay, all right, Girish, also give us a sense about asset quality. What should the numbers we work with on credit costs as well as asset quality for FY23?
Yeah, in terms of asset quality, I think last 10 quarters, I think our asset quality has been improving quarter on quarter in spite of COVID, in spite of moratorium, in spite of restructuring. I think on asset quality front, we are currently at about 0.65%. So it should be in that range, maybe plus or minus 2 or 3 pips. I think that will be pretty stable for next many quarters to come. In terms of credit cost, we don't anticipate any increase. So it will be in the range of about 0.12 to 0.13. I think nothing change on credit cost per se.
Okay, Mr. Kousgi, we'll leave it at that. Thanks a lot for joining us and giving us an update on the business. By the way,